Today, we're trying to get our heads around a truly mind-bending figure. $1 trillion.
A trillion.
Yeah. We're diving into these CEO mega grants. The research defines them as, single equity grants over $50 million. And specifically, we have to talk about the latest Tesla compensation package. It's just unprecedented.
It really is. And that figure, it's more than just a headline, isn't it? It's like this huge financial event.
Right.
So our mission today is really to look past the, frankly, staggering numbers and unpack what's going on with this type of executive pay.
Okay.
We need to give it some historical context, look at the different reasons, the motivations behind these grants, because they're definitely not all the same.
No.
And then, crucially, compare the conditions, the scale of this new Tesla package against, well, everything that came before it and what we normally expect from corporate governance.
It makes you wonder, has the playbook for rewarding founders just been completely torn up?
That's the question. Exactly.
I mean, just to set the stage again, that potential value of the Tesla package approved for 2025.
$1 trillion potential, yeah.
According to the sources, that's worth roughly twice the entire yearly GDP of Bangladesh.
Wow. That puts it in perspective.
It totally resets the bar for executive pay. This isn't about rewarding what happened last year. It's all tied to this incredibly ambitious, decade-long vision of turning Tesla into an AI and robotics leader. So let's get into it.
Let's do it.
So, okay, if $1 trillion is the new extreme, where did this whole trend of giving massive one-off stock grants even start? When did it go from being this weird anomaly to, a standard tool?
Well, historically, the kind of benchmark example people point to for a modern, really big CEO grant is probably Tim Cook's RSU award.
At Apple, right, when he took over as CEO in 2011.
Exactly. That award was valued at about $384 million back then.
Which sounds huge, and it absolutely is, but context is key with these mega grants, isn't it?
It's everything, yeah. Because if you look at that grant relative to Apple's size at the time,
Yep.
Cook's award was actually a pretty small slice, relatively speaking, about 0.1% more of Apple's market cap, which was around $312 billion then.
0.12%. Okay.
And importantly, it was structured very clearly as a retention tool. It vested over 10 years, a long time. He had to stick with the company.
Right. So that model is basically pay for staying, pay for performance over the long haul. But the research breaks down these mega grants into different situations, doesn't it? 3 main contexts?
That's right. The research identifies 3 primary contexts where you tend to see these pop up.
Okay.
First, in connection with an IPO, an initial public offering.
Makes sense.
Second, when a new CEO is hired or promoted, like the Cook example.
Got it.
And third, for CEOs already in place, maybe linked to renewing their contract, or sometimes it's called a refresher grant.
And we tend to think of these massive paydays being, a tech thing, Microsoft, Alphabet, and so on. But the sources show it's actually broader than that.
Oh yeah, much broader. It's definitely not just tech. We see examples in entertainment, retail, telecoms, financial services. The research mentioned places like Charter Communications, Walmart, Live Nation getting big grants.
Yeah.
It's become a strategy across different industries.
Interesting. So it's a widespread tool.
And linking back to those 3 categories,
Yeah.
the distinction between them is really, really critical because it completely changes the conditions attached to the grant.
How so?
Well, the analysis suggests that the IPO mega grants are often, by far, the most generous.
More generous than Cook's 0.12%. How much are we talking?
Way more generous, relatively speaking, often valued at maybe 2%, sometimes even 3% of the company's market cap when the grant happens.
2 to 3%. Wow.
Compared to fractions of a percent in the other contexts, yeah. But here's the kicker. The vesting conditions for these IPO grants, often much, much looser.
Looser how? Like no strings attached.
Pretty much in some cases. We saw examples like Snap, JD.com, Xiaomi. Xiaomi's grant in 2018 was worth $1.5 billion, about 2.8% of their market cap. And it apparently vested fully just on the grant date or when the IPO closed.
Seriously?
Yeah. No ties to future performance, not even necessarily tied to staying with the company long term.
Okay, so if Cook's grant was like, stay here and build value, the IPO grant sounds more like a massive upfront reward, almost like cashing out for the work done before the IPO.
That's a good way to put it. It feels more like a reward for getting the company public, for the founder's risk and effort up to that point, rather than an incentive for the next 10 years of performance.
Like selling 3% of the company right at the start, basically.
Kind of, yeah. It's a very different philosophy. Now let's shift to those other types, the new hire or the refresher grants, like the 2018 Tesla grant.
Right.
There, the value might be a bit lower, maybe under 1% of market cap usually. But the conditions, they tend to be way tougher, much more rigorous.
Okay, so this is where that pay-for-performance idea really comes into play.
Exactly. That 2018 Tesla grant, which was valued around $2.6 billion then, or a similar one at Axon Enterprise for its CEO, both were set up as 100% pay for performance.
Meaning?
Meaning, vesting was completely tied to hitting specific, objective, preset milestones. And they often had to be hit in sequence.
And for Tesla in 2018, those weren't easy targets, right? They were pretty ambitious.
Oh, incredibly ambitious. Massive growth targets, things like hitting escalating revenue goals, adjusted EBITDA targets, and ultimately getting the market cap to 12 times what it was then.
12 times.
Yeah, these are hard, measurable business goals, a world away from some of those IPO grants where just, sticking around seemed enough. This demanded hypergrowth.
Okay, this brings us to the really tricky part.
Yeah.
Governance. When grants get this big or stretch out over so many years, the shareholder watchdogs must start paying attention, right?
Absolutely.
For listeners maybe not familiar, can you explain Institutional Shareholder Services, ISS, and kind of where they stand on these long-term mega grants?
Sure. So ISS is basically the biggest firm advising institutional investors. Think huge pension funds, big asset managers, on how to vote their shares on company proposals. Executive pay is a major one.
And their advice carries a lot of weight.
A huge amount of weight. And historically, yeah, they've been pretty skeptical about these really large multi-year grants.
Why is that?
Their general stance is that grants covering more than, say, 4 years can tie the board's hands. It limits their ability to adjust pay later if circumstances change, if strategy shifts, or if performance isn't there,
So they prefer shorter-term views.
or at least more flexibility. And the data bears this out. In a sample of 10 companies the research looked at with these kinds of grants, what ISS guidance was available. ISS recommended voting against the pay package in 8 out of 10 cases.
8 out of 10, that's strong opposition.
It is.
And that opposition, that skepticism, it leads us straight back to the previous Tesla pay package, the $55 billion one from 2018 that got thrown out by a court in Delaware.
That's right, a landmark case.
Given how much was at stake, what was the court's actual reasoning for canceling that massive award? It wasn't just the number, was it?
No, not just the size, although the judge definitely called the amount unfathomable. The core issue for the court was the process. They found it was fundamentally flawed.
Flawed how?
Well, the court pointed to strong evidence that the directors involved weren't truly independent. Conflicts of interest. And maybe even more importantly, they found the board hadn't really shown why this enormous grant was actually needed to motivate the CEO.
Needed? What did they mean?
They basically argue, look, this CEO already owns a massive chunk of the company, like 21.9% at the time. He's already incredibly incentivized to see Tesla succeed. The board, the court said, failed to show that this specific huge grant was necessary to keep him focused or working hard.
So the directors weren't independent enough, and they didn't justify the why.
Exactly. The process was seen as tainted, not robust. The court stressed that compensation committees need to be genuinely independent. They need to look at market comparisons, consider the CEO's existing ownership, and think about how shareholders will see it.
That's a pretty sharp rebuke of the board's work back then. It seems like the only times ISS was okay with these big grants were cases like Apple or GoPro.
That's what the sources indicated, yeah.
Yeah.
In those instances, the awards were structured differently, more like long-term time-based vesting. Basically, you get it if you stay employed for the period. Less complex performance hurdles.
Okay, so 2018. Flawed process, conflicts, grant unnecessary, struck down by court. Fast forward just a few years, and the board comes back with a package potentially 18 times bigger. How on earth did they get that approved?
That really is the billion or trillion dollar question, isn't it?
Yeah.
Because you're right, the opposition was intense. Major institutional investors like Norges Bank, CalPERS, big advisory firms, Glass Lewis and ISS,
Yeah.
they were all against it.
All recommending no?
Pretty much all the big governance players.
Yeah.
And yet, shareholders approved it. Overwhelmingly. 75% voted yes.
75%. Wow. What stands out here is just the sheer scale, the audacity of it.
Absolutely. That potential $1 trillion payout, 18 times bigger than the one the court threw out,
Well,
the board really had to sell this, and they did it by framing it as absolutely essential. They played the superstar CEO card hard.
meaning they argued that without this package, the CEO might just walk away, or at least focus his energy elsewhere.
Exactly. They basically said, look, if you don't approve this, he could easily spend more time on his other big ventures, SpaceX, XAI, Neuralink. And if he does that, Tesla's stock could collapse because so much value is tied to his vision and leadership.
So it was framed as an existential risk. Pay up or risk losing the visionary.
Pretty much. They positioned it as the only way to secure his commitment to Tesla's really ambitious future in AI and robotics. His brain, his vision, is the company's key asset, and you have to pay whatever it takes to keep it focused here.
Okay, let's talk about what it takes to unlock that $1 trillion. The targets are, well, they sound like science fiction. Can you walk us through some of the 12 performance hurdles? The numbers are just staggering.
They really are. Let's start with the financials. To get the full payout, the company's market cap has to grow from around $1.5 trillion now to an incredible $8.5 trillion.
8.5 trillion.
That's an increase of like 466%.
Yeah.
And for context, $8.5 trillion. That's roughly the size of the entire German and Japanese stock markets combined right now.
Okay, that's not growth. That's building an entirely new economic superpower.
It's demanding Tesla become its own economy, essentially. And then you have the operational targets, which are not just about selling more cars anymore.
No, this is the master plan 4 stuff, right?
Yeah.
All AI and robotics focused.
Completely. It's shifting the whole basis of CEO evaluation. The targets include things like deploying 1 million robotaxis commercially,
A million.
selling 12 million more cars, yes, but also getting 10 million full self-driving subscriptions,
Yeah.
and producing 1 million humanoid robots, Optimus.
A million walking robots.
Plus, the profitability has to be there too, reaching annual adjusted operating profits up to $400 billion. I mean, these targets look like they belong on, I don't know, a sci-fi movie poster, not a corporate comp plan.
It's wild. Okay, let's try and ground this a bit. How does this potential payout compare to what other, top-tier tech CEOs are making?
Right, the peer comparison really highlights the scale. If you look at recent total annual compensation figures, Satya Nadella at Microsoft, his reported total comp for 2025 was around $96.5 million.
Okay, nearly $100 million. Still huge.
Huge, yes. Tim Cook at Apple, about $74.6 million in 2024. Sundar Pichai at Alphabet, his pay jumps around because of big multi-year grants, but even his peak year in 2022 was about $226 million.
So best case, a couple $100 million a year for the very top CEOs.
Astronomical numbers by any normal standard. But this potential Tesla package just dwarfs them completely.
If the CEO hits all targets and gets the full trillion over 10 years, what does that break down to?
The math works out to average daily earnings of roughly $275 million per day for 10 years.
That's more than entire companies are worth.
It's operating on this decade-long time frame, much longer than most CEO deals. And here's the governance point that still lingers. It got approved, even though critics argued it gives one person immense, maybe unchecked, power. And crucially,
Yes.
the new package apparently doesn't limit his other activities. There are no restrictions mentioned on his political statements or even a minimum amount of time he has to physically spend working at Tesla.
Hang on. The court slammed the last deal partly because they couldn't prove it was necessary to keep him focused, given his existing stake. Now they approve a deal potentially 18 times bigger with no minimum time commitment.
Seems that way.
Doesn't that kind of suggest that the board and maybe the shareholders who voted yes care more about the idea of the CEO, his brand and vision, than about traditional governance or day-to-day management?
I think that's a very fair interpretation, yeah. The approval signals a really significant shift away from traditional corporate governance. It's leaning much more into this founder-centric, almost indispensable leader model.
Where the CEO is seen as irreplaceable.
Exactly. Irreplaceable, indispensable. And keeping him involved, even without specific time guarantees, is worth taking on extraordinary financial risk and, arguably, structural risk for the company.
So for you listening, the takeaway here seems pretty clear. This trend isn't just about big numbers. These mega grants, especially this one, signal a shift. Boards might be starting to value speculative future potential AI, robotics, visionary leadership way more than current financials or traditional governance checks and balances.
They're essentially paying for a possible future, maybe even a science fiction future, not just today's reality.
Which leads us to the final thought we want to leave you with.
If the benchmark for top executive pay is now potentially tied to hitting these incredibly ambitious AI and robotics goals, an $8.5 trillion market cap, a million humanoid robots, instead of just revenue and profit growth, how long before other companies feel they have to offer similar, maybe even trillion-dollar level packages to attract or keep their own superstar tech visionaries?
That $1 trillion mark, maybe it won't be an outlier for long.
It might just be the start of something very different.